Canadians who are residents to Canada, as well as deemed residents, which I'll go into in a little bit, are required to pay taxes on their, catch this, worldwide income.
Oh.
So not just Canadian income, not even just American income, worldwide income.
Welcome to my YouTube channel. My name is Reni. If you're new here, welcome, and if you're a returning subscriber, welcome back. On my channel, I do fashion, finance, lifestyle, and career, and today's video is going to be all about finance and financial literacy regarding taxes. So I know that a lot of us have questions about taxes, and I personally don't have the answers, so I brought an expert to answer all your questions for you. We recorded remotely, and this is my first time recording remotely, so let me know how the quality is, if it's okay with you, if you prefer these sessions to be live. Like, just tell me all about that just so I can make content that you really like. We'll be talking about personal taxes and how you can lower your income tax with your RRSP. If you receive CERB this year, how you need to treat your CERB payments because it's not free money, and just a lot of other tips. If you have questions for Stephanie, the accountant that I interviewed, you can leave them in the comment box below. And I also will leave all her details in the comment box because she is absolutely amazing. She's a wealth of knowledge and she'll be able to answer your questions for you. And you should definitely patronize her business if you can. This is a Canadian focused video, so if you are abroad, this does not apply for you. Go watch this playlist if you to learn other things about financial literacy. This video was getting a bit long, so we recorded a part 1 and part 2. This is part 1. If you want to see part 2, it will be up shortly, and once it's up, I will include it right here and in the description box. So I hope you enjoy, and let's start now. So today's video is, I have a special guest, as you can obviously see. I have Stephanie here with me.
Hello.
And today we're going to do a video all about, well, Stephanie's an accountant, and today's video is going to be about taxes, personal taxes, and I asked you lots of questions. I asked you to present me with questions on my Instagram, and you guys had so many questions for Stephanie all about your taxes, and how a lot of people asked how you can reduce your taxes, as I expected. So yeah, I'm very excited to have Stephanie here to answer all these questions for you. And I'll let Stephanie introduce herself.
Hello, everyone, and Reni, thanks for having me. My name is Stephanie Williams. I'm a chartered accountant and CPA, certified professional accountant, and I'm the owner of Serenity Accounting and Consulting Services. I've been in the finance or accounting industry for over 11 years, and my area of expertise is around personal and corporate taxes. So that includes small businesses, accounting for small businesses, charities, nonprofits, and a number of other services around payroll and accounting. So I'm super excited to be here, and I'm excited to share the knowledge and the wealth about taxes so that we can all keep our coins.
Yes, so we all want to keep our coins because, you know, the Canadian government takes a lot of money from us in the form of taxes, although we see it going to good. But of course, any insight you can share would be amazing. So I have a list of quite a few questions, and today for this video we'll just focus on personal taxes, and then we'll do a separate video all about business taxes. So if you are interested in that, you can watch it up here, and I will link that second video up there. We're going to start with the very basics about what the role of an accountant is. So what does an accountant actually do?
Sure. So as it relates to income taxes, an accountant can take various roles. So an accountant can be the individual who actually prepares the financial information that is required for tax filing. So if you have your business, that can be compiling your balance sheet and income statement, which is the basis of your tax filing. Even if you're a sole proprietor, you will need to have this information as well. And for all parties, it's really the income tax preparation and filing with the CRA. Another one, and a major one that I see as it relates to accountants' role is that tax planning or advisory services. So really looking into, okay, how can I be in a better tax position next year or the years down the line? So really positioning yourself and finding out what you need to do today to optimize your tax situation.
Okay, cool. I know that my parents personally have an accountant with their business. So he also does my income taxes. So I've never actually had to use an accountant personally. So I'm going to learn a lot. So what is the right time to actually approach an accountant?
You always hear that the right time or the best time is now. Yeah. And I completely agree. And it's not just because I'm biased. Effective tax planning requires you to go at it ahead of time. So that means being in the driver's seat and really planning out the route that you're going to take to make sure that you're effectively managing your taxes and planning out what it's going to look like 10 years from now, 20 years from now. But at the same time, there might be individuals who are a little behind in terms of tax planning and behind in terms of tax filing as well, because it happens. We're human. And I would say the time is now again, because the CRA does charge interest and penalties on balances owing. So if you owe a balance, it actually compounds pretty quickly daily. So you want to make sure that you are addressing those past due amounts as soon as possible. And you won't know which position you're in until you do that tax filing.
Oh, wow. That's actually really good to know, because I don't think a lot of people know that at all.
Exactly. And on the flip side, if you're not in a tax owing position, if you are in a refund position, of course, in these cases, the CRA isn't hunting down to give you your money, but it does benefit you to actually file your taxes so that you are accessing benefits such as your child care benefit, your HST return that comes quarterly, or if you're in Ontario, your Ontario Trillium benefit, which also comes quarterly.
Would it be once I turn 18, I start getting an accountant, or what do you suggest?
So in terms of tax filing, once you start working, you are required to file your taxes once you have income. But I do recommend individuals, and we go through this question a little later on, but I do recommend individuals who are not working, who are 18, to also file their taxes because you are eligible for benefits such as the Ontario Trillium, based on if you meet the eligibility criteria, but especially the GST credit. So certainly, if you're working, you should be doing it. Once you hit 18, there are benefits to also doing it, even if you aren't making income.
Okay, good to know. So basically, to summarize, the right time is now. How much can I expect to pay an accountant?
So how much you expect to pay an accountant really varies. It varies based on how complex your tax scenario is. So if you have a lot of investments that are such as rental income and stocks that are being tracked separately and not getting a slip for, those are the areas where your tax filing might be a little bit more expensive than your basic tax filing, which just has some income, a couple deductions or credits, which you're expected to pay anywhere between $40 to $60 or $70 to file.
Oh, okay. So it's not that expensive. So why wouldn't someone get an accountant, right?
Exactly. And especially for the ones that are pretty basic, where you get more complexities is where it does add up. But there's certainly benefit there because you want to ensure that you're maximizing your tax deductions and credits where available. And you are getting certainly the best tax advice.
Okay.
Yeah.
And just to plug you, if someone wanted to use you as their accountant too, if they are whether they're complex or simple, could they reach out to you?
Absolutely. So I'm available on Instagram at XORENITY Accounting. So SERENITY accounting. As well, you can send me an email at contact@serenityservices.ca.
Perfect. And I'll leave these details in the description box as well.
Thank you.
So another question that people had was, okay, so I know that I need an accountant and I'm in the process of looking for one. How do I actually choose a good accountant? Are there specific qualifications that this person needs in order to be licensed as an accountant? And how do I choose that person?
Sure. So I always say in Canada and pretty much around the world, not all accountants are created equal or are the same. The routes that you can take to become an accountant vary, especially in Canada, where you can go through industry. So that's working for a company directly. You can go through public accounting, which has tax, audit, and various other roles. And in Canada, if you're not designated, you can technically use the term accountant without being a CPA or a chartered accountant, CMA, CGA, which are the legacy accounting roles. Okay. So I always say, don't assume that all accountants know the same thing and do the same thing and therefore are qualified for what you need. You need to interview that accountant and find out what is their area of expertise. Where do they do business? What is the industries that they cover? And that way you can find out whether or not they are the right accountants for you. For example, one of the questions may be if you perhaps are an American living in Canada, you can ask whether or not they do cross-border accounting and cross-border tax filings as well. So it's really interviewing the accountant to see what their area of expertise is and whether or not it aligns with what you require. And the second point, actually, for individuals who are using the designation as chartered accountant or CPA, my apologies, I would recommend actually doing a little due diligence. So in Canada, CPA Ontario, CPA Canada have membership directories available online for the public to see. Search up their name, see whether or not they're actually registered and if they're in good standing. The thing is, it's absolutely a must. And the reason being is that these regulatory bodies, our oversight bodies, are there for a purpose. So I don't know about you, but when I was a teenager, we had an accountant, and or who we thought was an accountant, who did our family's taxes, and it messed everything up. And it took years of sort of unraveling the mess that was created out of that simply because of errors that were filed with the CRA. And that kind of propelled me to my route as well. And you know what? If we had done that due diligence to actually look up a little bit more detail about this person, see whether or not they were actually registered, and if there was a sounding board to go to where we can file complaints, that would have certainly stopped other people from being impacted as well. And at least we would have been able to share our grievance and sort of recoup from that. So those are the tips I have.
That is good to know. I did not know that. Do you know where would we go and research this? What is the regulatory body that we would search it on?
So you would go to CPA Canada. Okay. And you can just find it. I believe it's cpacanada.ca, if I'm not mistaken. And you would look for the membership directory. Okay. And you would just search by the individual's name.
But you also said that CPAs don't, or not all accountants are CPAs, right? So if they're not a CPA, they wouldn't be there, I'm assuming.
So if they're not a CPA, they would not have an oversight body. So in those cases, you are sort of relying on the expertise of that individual, but you don't have that additional oversight body that you can go to file any complaints or follow-ups.
Okay, so would you say it's better to go with a CPA? Well, you are a CPA, so I'm sure
I'm biased. I am biased. It truly is a personal decision in terms of what you're comfortable with. Personally, if I was to go back to when I was younger and my parents were choosing who the accountant was doing our tax filing, I would have pushed for an individual who had that oversight body, so a CA or CPA in that case.
Okay. We know that we should get an accountant, but now we're moving on to the actual questions that people had to ask you. What does it mean to file taxes? How do I file? When do I file? Why do I need to file? And where can I file? So basically a general overview of filing taxes.
Sure. So the Canada Revenue Agency, the CRA, requires residents and even some non-residents who are deemed to be residents to file or submit what their income is every year, what their eligible expenses were, if you have a business, as well as how much taxes you paid during the year. And depending on that information provided, you fall into what's called a tax bracket, where based on your income, you have to pay a certain percentage of that income to the CRA every year to cover programs, et cetera, as a part of your commitment to being a Canadian citizen or a resident of Canada. Now, if you've overpaid or if you've paid too much during the year, that's where you get a tax refund. So it's not actually the government giving you free money, it's you getting a return of the money that you loaned to the government over the year. Now, if you didn't pay enough taxes during the year, that's where you have a balance owing, where you have to pay up what you should have paid during that tax year. Now, why do you need to file? It's a regulatory requirement. The CRA, when you're in a tax owing position, they more quickly identify those who have not filed through their algorithms and audit processes as well. It's when you're in a refund position, they're not as quick to let you know and nudge you that they owe you money. But it is a tax requirement and a regulatory requirement as a resident to file your taxes. And when do I need to file? So if you are an individual, so you don't have a business, whether it be corporate or personal, corporate or sole proprietorship, you're required to file by April 30th after the year end. So, and this is calendar year end. So After December 31st, the following April is when you're required to file your taxes. If you or your spouse is a self-employed individual, so if it's a sole proprietorship, or if it's even a non-registered business, your income tax return needs to be filed by June 30th. And I can include as well if you have an incorporation. The incorporations are required to file 6 months after your year end. So if your year end is December 30th or 31st, then you're required to file by the end of June.
Okay, good to know. And I'm sure all these things can be found on the CRA website as well. So just to build on that, why would I not have paid enough taxes during the year, or why would I have overpaid my taxes during the year?
Good question. So there can be a number of reasons why this may happen. One reason can be if you're an employee, it can be if your place of employment does not deduct enough taxes off of your paycheck every biweekly or whatever the cadence is that you get paid. Another reason can be if you have multiple places of employment, and that pushes you into a different tax bracket. So, for example, your first place of employment might be deducting taxes, assuming you're in one bracket, but with the other income, it pushes you to another bracket, which requires more taxes to be paid. So another reason where you may get a refund, actually, is perhaps if you do have multiple places of employment or multiple jobs, and they're taking out CPP and EI in both places of employment. So CPP, Canadian Pension Plan, NEI, Employment Insurance, are capped at a maximum every year. And those maximums are communicated prior to the beginning of that year. So your employer assumes that this is the only place that you work. Therefore, they take out the maximum required, but they might be taking it if you work multiple places. They might be taking it from all of those various employers that you have. So in those cases, you have a case where you get refunded or returned back CPP or EI that you've overpaid during the year.
Okay, that makes more sense. So I guess it's not about it's not like we have to pay attention to our employers, like see what they're deducting, but at the end of the year, you should definitely check and make sure that, and I'm sure the CRA will keep us accountable anyway, even if we don't check, right?
So yes, but so effective tax planning would require for you to at least take a look, check your pay stub. If you're not getting taxes taken off, that's a red flag, and you don't want to be in a position where at the end of the year you have a huge balance owing and you didn't think about it, right?
Yeah.
If you are self-employed, for example, and you're giving out invoices, you don't have any taxes that are being deducted. So in those cases, that you have to make sure that you're putting aside some amounts for tax purposes, and making sure that you maximize on all of your credits and deductions possible.
And I think that's a mistake a lot of self-employed people do make. They think, oh, I just got this $1,000 invoice, I have so much money, but it's actually not all your money.
Exactly.
Another question that we had was, do I have to declare passive income on my taxes? So for example, I have a video about passive income, like if you get dividend income or if you get capital gains from your shares that you have. So if you could answer that question for us.
Certainly. So the answer is yes. So Canadians who are residents to Canada, as well as deemed residents, which I'll go into in a little bit, are required to pay taxes on their, catch this, worldwide income.
Oh.
So not just Canadian income, not even just American income, worldwide income. So that means you have to declare all of your income, including your passive income, dividends, interest, etc. And then you take your necessary eligible deductions or credits to come out with what your taxes payable should be, less your taxes actually paid. So thankfully, there are tax treaties with other countries to make sure that we are not being double taxed. However, you still have to declare this income and then take that credit.
Wow.
So Canada needs to know.
I'm sure a lot of people do not know that. I'm sure. But if my money is in my TFSA, for example, so you're saying that I still have to declare it. They're just not going to take money out of my account, or I don't have to declare it?
So for TFSA, it's a little bit different. So TFSA, you're contributing with your after-tax income.
Oh, okay.
So, and then the way that it's developed or designed is that income can grow tax-free. So TFSA, and it's usually with some sort of established organization. You're not going to be getting a slip for that because it is growing tax-free.
Okay, that's great.
Yeah.
So everyone should be maximizing their TFSA if they can. So the next question we have is about a hot topic, and we received quite a few questions about this one, and this is about CERB and CRB. I will leave what the actual acronym is on the screen, but during the pandemic, the Canadian government gave us these benefits, and a lot of people want to know, how do I treat this? Is this income? Do I have to declare this on my taxes? Like, how do I actually treat this money that I was given by the government?
Good question. I will discuss them separately because the treatment is different. So in both cases, the Canada Revenue Agency will be giving a slip that indicates how much income you received during the tax season. So that'll show how much money you got, less any taxes that you paid on the money. So in the case of the CERB, that was given at 100%. There were no taxes deducted at all. And the idea or the thought behind it from the government perspective is they want to get this money in the hands of the individuals, and will deal with the taxes later. Mm-hmm. So unlike EI or typical EI, where you get an amount deposited into your bank account and you don't have to worry about taxes because they already took it off, that was not the case with CERB at all. So a lot of individuals, there was a lot of discussion or thought around, oh no, I'm going to have to pay taxes at the end of the year. And it really depends. It's an individual by individual basis. It depends on quite a few things. One, where you land in your tax bracket. At the end of the year, where are you sitting, right? Because that determines how much percentage of taxes that you need to be paying. Mm-hmm. Secondly, what credits or tax deductions are available to you? What are your circumstances? Do you have children? Do you have medical expenses? Do you make donations? So there's various different things that are available as a tax credit or deduction that reduces your taxes owing at the end. And so that determines where you land in terms of a balance owing or a refund position. So the second one, which is the CRB, which began, I believe, in September 2020, that one, the government said, okay, we are going to take away 10% for taxes. So they're going to give it to you at a 90% of the amount that you're eligible for. So similar case in terms of at the end of the year, depending on your tax bracket and credits, it'll really indicate whether or not you owe more than that 10% or if you have a balance owing in that case.
Okay, cool. So the long story of it is, CERB is not free money that you've gotten. You still have to declare it on your income. Sorry.
Exactly.
Yeah, but you have to declare it as income. However, whether you have to pay more or less is based on your total income that you have.
Exactly. It's based on your circumstance and what you have available to you as a credit.
Okay, perfect. That's good to know. Lots of people need to know that one. So a lot of my followers and my subscribers are international students who are based in Canada, and they wanted to know, as a non-resident, do I have to pay taxes within my TFSA? Can I even open a TFSA? My understanding of the TFSA is that non-residents can open it, but some people have told me that based on their SIN number, they're not able to. So I wanted to know if you could clarify this.
Yep. So actually, any individual who's a non-resident should be able to open a TFSA with a valid SIN number as long as they're 18 years of age or older.
Okay, great.
So they should be able to open the TFSA. The caution or the tax implication is that any contribution that sits in the TFSA is subject to a 1% tax per month. So if in January you contribute $1,000, every month you'll have to pay $10 taxes on that contribution.
Really?
Yes. So that's sort of the tax implication for non-residents to access the same vehicle as the Canadian residents.
Okay, so 1%. So it's not a huge amount, but they still not completely tax-free.
Exactly.
But for a resident, it would be completely tax-free.
Exactly.
Okay, that's good to know. I'm sure a lot of people, I'm learning a lot because I didn't know that. I definitely didn't. And does that automatically come out of their account, or would that be something at the end of the year they put on their return? Like, how does it'll be accounted for on the return. So it does not come out monthly. So it's not like the bank deducts it every month.
but it'll be one of the things that are indicated as a part of the tax return at the end of the year when you do the filing.
Okay, another person says, at what income bracket do you suggest people start putting money away in their RRSP? And for anyone who doesn't know, an RRSP is a registered retirement savings plan.
Good question. So I will give a little background on how the RRSP works first, and then it'll help to understand sort of the income that or bracket that I suggest people start putting money away. It is a tax deferral mechanism. So what that means is that you don't avoid taxes for the rest of your life. What you do is you don't pay taxes now because you plan to pay taxes in the future. And the whole idea of it is that you contribute or you make contributions when you're in a higher income tax bracket, right? So that you get a deduction to reduce your taxable income. So that later, when you estimate that you're in a lower income tax bracket, when you're actually retired, you pay taxes at that lower rate. So if you think about it, the benefit truly is for people at a higher tax bracket now who are making a lot of money now, who anticipate that when they retire, they might be taking out less money to maintain themselves. That would be the perfect or ideal situation to use this vehicle. Now, in terms of what income should you contribute, the first thing I want to say, if you have an employer who gives RRSP contribution matches as a part of your workplace package, it doesn't matter what income you're at, take that free money. Contribute, get that match from your company every year and use that up, right? Because if you don't use it, most likely you lose it. Okay. The second thing is in terms of what income bracket you should start putting away money in the RRSP. I generally suggest the sweet spot is somewhere between 60 to 70,000. So in terms of income earned. And the reason for that is that generally speaking, at that point, you start sort of maximizing if you're not an employer, as in a sole proprietor, or have an incorporation where you can manage taxes other ways. At that point, you sort of start to maximize on some of those credits, and you need a push to bring down your taxable income. So I would say around 60 to 70K. A lot of accountants, such as myself, do RRSP planning packages where you go through the client and really assess, okay, at what point should I start contributing to my RRSP? So I would recommend if you're sort of on the cusp to sort of look into it. There are many different tools, even online, where you can put in the numbers and calculate it yourself to see what that impact would be on your taxes.
Okay, good to know. And so are you saying that if I make less than 60K and my employer does not maximize or give any benefit, like matching, I should not contribute? Is that what you would say?
I would say that I would first maximize my TFSA.
Yeah. Okay.
Yeah, I would max that, and then I would go to RRSP if I so wish. But I wouldn't do nothing. I would certainly just use one vehicle over the other.
Okay. And I know that you can invest through your RRSP. Do you suggest doing that? I know a lot of people just use it as a savings account, but do you also suggest investing through your
Absolutely. And I believe that that should be one of the key reasons to using your RRSP is truly using it for the full advantage, which would be investing, having those gains through your investment vehicle, similar to that of TFSA.
Agree. I always want people to invest, but some people are very risk averse, so I get it. But as you said, if you want to take advantage of the full benefits, you should definitely be investing through your RRSP and your TFSA and your RRSP, right? Like every tax benefit that we get, we should be investing through it. So the next question that we have is, are there any other ways to lower your tax bracket aside from loading up your RRSP?
Absolutely. So as an employee, and I will say this first on, the number of credits or tax deductions available is significantly lower than that of a sole proprietorship or another business owner who's incorporated or partnership. So I will put that out there first, but there are some ways of legally reducing your taxable income and paying less taxes through effective tax planning. So one of the ways is income splitting with your spouse. So there are certain benefits that you can do, such as, and I go into detail a little further about a marriage question, but such as loaning your spouse funds to invest in a vehicle, not an actual vehicle, but invest, whether it's through your TFSA, et cetera, and really adhering to the specific guidelines from the CRA on what that investment looks like. So the CRA is very particular about how you structure it. And the reason why you would do this is because that income that's earned on whatever that investment is would go to your spouse, who's the lower income spouse, and will not be attributed back to the higher income spouse.
Okay.
So that's one way of tax splitting or income splitting. Another reason, or another way that you can reduce your taxable income is if you have a corporation or a business, it's controlling when you're paid salary. So if you think about it, you are taxed in the calendar tax year, right? So for example, if you were supposed to be getting paid on Friday, December 31st, deciding to push that to January 1st would automatically push you into a different tax bracket if that would have brought you over the cusp.
Ah, okay.
So it's really controlling the timing of payments that you are able to do when you have a business versus otherwise. So there is another vehicle to optimize your taxes or reduce your taxable income. And that is if you are with a spouse, whether it be common law or married, you can actually optimize your situation and reduce your taxable income by sharing different tax credits or deductions. So some of the common ones are donations or medical expenses. So it doesn't matter who actually pays those expenses, depending on who the best benefit would be for taking those deductions, they can be optimized or allocated to that spouse.
That makes sense, and I think people should reach out to an accountant to like figure out which plan would be the best for them, because I know I would be like confused by all the rules that are
Exactly. And that's exactly it, because there are so many variables in terms of individuals' personal situations. It's extremely hard to make a broad statement on how to reduce taxes unless you understand what the individual's circumstance is and what sort of income, expenses, credits are available to them, which is an individual thing.
Okay, so I realized that we have quite a few questions, and this video is going to be very long. I'm sure it's very long already. So we're going to do a part 2 of this video, and I will link it up here so you guys can watch it. So we'll see you in the next video.
Ciao.